Good morning. I'm going to talk to you briefly about a concept in portfolios called the efficient frontier and how it's relevant to markets at present and how it will help you to understand where your portfolio will be at some point in the future. So I will make myself smaller. So here is Navigate 40, which is one of our 10 portfolios. And Navigate 40 has 40% of the investment in the stock market and 60% of the investment in bonds. And if you look at the performance since, where are we now? Feb 2014, you will notice that you can draw almost a line through the portfolio. And although it breaks away from this line, it returns to this line at various points. And this line exists in all diversified portfolios and was discovered by an economist called Harry Markowitz in the 1950s. Now, he did all this by hand and with ledgers, and noticed that if you got enough securities, stocks, for example, had enough of them and they behaved in this manner in which you saw this relationship between risk and return, and this line that goes straight through the portfolio is called the efficient frontier. Now, the efficient frontier helps us with WealthMap because we use the efficient frontier for Navigate 40, 50, 60, 70, 80, whichever portfolio we're using for you and your objective, to help us to decide which is the expected rate of return that we're going to use for your portfolio. So Navigate 40, we might use something around 4% net of all fees. And if we take a look at the performance table now, on an annualized basis, Navigate 40 has produced higher than that. So over the last 7 years, 5.95%, 5 years, 4.7%, and 3 years, 5.16%, and obviously dropped off in the last 12 months. Back to the graph. So what that means for your portfolio is two things. One, you can see here, this period where it's left the efficient frontier, and we would describe this or articulate this as volatility with the markets, and we know that at some point the portfolio will pick up again and pick up the efficient frontier at some point at a later date. So what that means is that as you can see, the portfolios and the stock market is fantastic at generating wealth, fantastic at building returns and compounding, but it doesn't offer a fair value at all times. It leaves the efficient frontier. And the extent to which it leaves the efficient frontier, the more it leaves this line that we draw through, the more the individual must be compensated in some way. Because if you were an investor here and your portfolio dropped by more so than Navigate 40, dropped all the way down to here, and then picked it up again, there's no reason why you'd hold Navigate, any other portfolio other than Navigate 40, unless something else happened. And that is the relationship between risk and return. So if we take Navigate 60, it leaves the efficient frontier to more of a degree. Look at when the pandemic news arrived, it's a much sharper downturn. And for experiencing a sharper downturn, there is a steeper efficient frontier, and that translates into a higher return. So over since 2014, it's a 26% higher return. And that's the compensation that the investor receives for experiencing momentary periods of detachment for longer and more severe. Let's make it even more extreme. Let's take Navigate 80. Big decline when the pandemic hit, big snapback. Took much longer. So you're looking about Navigate 40 getting back, reattaching to its efficient frontier. Took Navigate 80 longer. So what's the compensation to the investor? 52% since 2014 of increased returns. So back to Navigate 40, we know that at some point, almost whatever's gone on in the market, we could spend 2 hours now talking about what's made the line do this. The thing to know is that at some point in the future, it will reattach to the efficient frontier and you will receive a fair value for your return. But there are times that are momentary and never permanent in which the portfolio leaves the efficient frontier. And if it didn't do so, there would be no benefit in holding any asset other than the cash. So I hope you feel that makes you feel a bit better if you've locked on recently and looked at your portfolio and noticed that the valuation is lower. If you look at it in terms of the grand scale of things, and you could take this graph and you could with our methodology in terms of how we build and navigate portfolios, this would hold true over any period of time, over and above more than sort of 5 years plus. And it only works when you have a collection of securities, more than about 30. And the more you hold, the easier it is to see the theory in practice in terms of the efficient frontier. So if you're wondering why your Tesla stock or your Amazon stock or your Peloton stock doesn't look like this, it's because there's not enough securities in there for there to be an efficient frontier. These are random securities for discovering random price. And you only see this when you hold a collection, like an index, which the 25,000 securities that you see in the Navigate portfolios is why it's so clear that you can see the efficient frontier in action.